Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
In today's episode, you'll learn about, first, today's US market review. Markets surge on a disinflationary surprise, but a $7.1 trillion triple witching event looms, threatening to unleash chaos. Is this a genuine rally or the calm before a volatility storm? Second, Fed independence under siege. Trump's high-stakes gamble to install a rate-cutting hawk triggers alarm bells. Who is the mystery candidate behind the wallet put, and will his appointment ignite a currency war and upend global markets? Finally, Intel's $8.9 billion gamble. The fallen giant's comeback plan stumbles as its most advanced chip has only one customer itself. With a shocking 92% of advanced chips made in Taiwan, is this the moment a tech titan collapses? Or will a little-known ace-in-the-sleeve technology trigger a historic turnaround? Markets are reacting strongly today, with US equities opening higher amid cooling inflation data. We've got a significant $7.1 trillion derivatives expiration event on our hands, known as triple witching, poised to inject volatility into the session. This is a crucial moment for investors to navigate the intersecting forces of softer than expected inflation and technology sector recovery. The S&P 500 opened at around 6,795, up by 0.33%, while the Nasdaq showed stronger momentum, climbing 0.51% as technology stocks regained favor. Although the Dow Jones posted more modest gains of 0.21%, its performance was dampened by a sharp 10% pre-market drop in Nike shares, despite the company surpassing earnings expectations. This divergence highlights the cautious yet optimistic undercurrent in the market today. Let's dive into the key event driving today's action. The Consumer Price Index, CPI, report for November 2025, released yesterday, which showed an annual increase of 2.7%, well below the anticipated 3.1%. This disinflationary surprise has reshaped near-term Federal Reserve expectations, providing a tailwind for growth stocks. However, this report is complex. It covers 2 months due to data collection disruptions during a 43-day government shutdown, making it unusually difficult to interpret. Despite the confusion, markets have embraced the low inflation print as genuine, sparking a rally in equities. 3-layered impact analysis. 1. Policy layer, The CPI report has recalibrated expectations for the Fed's rate path. Although the Fed recently cut rates to 3.5% to 3.75%, Chair Jerome Powell remains cautious about further easing. Current market pricing suggests little likelihood of additional cuts in early 2026, creating a mismatch between dovish data and hawkish Fed signals. This discrepancy could lead to volatility, especially if the Fed maintains its stance despite softer inflation. 2, capital flow layer, The bond market has reacted with the 10-year Treasury yield dropping to 4.25%. This indicates partial pricing in of the disinflationary scenario. However, equity markets remain vulnerable if real interest rates stabilize around 1.5%, a level insufficient to sustain high growth stock valuations. 3, valuation layer, The tech-heavy Nasdaq's outperformance suggests a tactical recovery in growth stocks, but not a fundamental validation of AI-related valuations. Investors should be wary of the exhaustion signal in tech's recent momentum, suggesting profit-taking in high-beta growth names that have surged over 15% this week. Sector-specific insights highlight the technology sector's 0.51% gain, with mega-cap stocks like Amazon, Microsoft, and Nvidia leading the charge. In contrast, semiconductor stocks display a mixed picture. Micron Technology surged 10% on optimistic AI demand projections, while Broadcom and Oracle faced declines due to AI infrastructure financing concerns. Meanwhile, Nike's earnings beat overshadowed by weak China sales, and tariff impact signals broader stress in consumer discretionary stocks. Sound investment decisions are built on clear analysis and risk awareness. Here's what to consider. Short term, 1 to 2 weeks. If inflation data continues to moderate, consider reducing exposure to high valuation tech stocks and exploring opportunities in financials. The XLF ETF, which tracks major banks, could benefit if yields stabilise. Asterisk, medium term, 1 to 3 months. Asterisk, assuming the Fed maintains its cautious stance, increase allocation towards sectors like healthcare, tracked by XLV, which offers defensive positioning with growth potential. Asterisk, defensive strategy. Asterisk. For conservative investors, maintaining higher cash positions and allocating to utilities or consumer staples, represented by XLU and XLP, can provide stability during potential volatility. Monitor key levels such as the 10-year Treasury yield at 4.5% and Nasdaq support at 23,000. A breach of these levels could signal shifts in market sentiment and necessitate portfolio adjustments. With that framework in mind, let's examine today's key developments and how they shape the broader market narrative. Now, get this. President Trump just went on the record with a bombshell statement. He said, "I will soon announce our next chairman of the Federal Reserve, someone who believes in lower interest rates by a lot." A while back, we noted he was already telegraphing that exact standard today. He's putting a timeline on it, and it looks like he may have found his man. Federal Reserve Governor Christopher Waller just concluded what senior administration officials are calling a strong interview with the president for the top job. We previously analysed the Fed's internal three-way split, and the latest development is that Trump is explicitly gravitating toward the rate-cutting camp for the chair. The core of this issue goes back to the Fed's dual mandate, a mission set by law in 1977. You see, the Fed is legally required to balance two goals: keeping prices stable and achieving maximum employment. The history of the Fed is a constant tug of war between these two objectives. For example, in the 1970s, the Fed prioritized jobs, which contributed to runaway inflation. In the 1980s, Fed Chair Paul Volcker did the exact opposite, crushing inflation, even though it caused a painful recession. The stakes are clear. A chair who tilts toward jobs would be a decisive pivot in that tug of war. The timing is critical. The November jobs report just showed the unemployment rate ticking up to 4.6%, with payroll growth slowing. This is the exact data that would justify a policy shift toward protecting employment. And remember, we flagged that revisions to past payrolls were a growing risk. Those adjustments are exactly what pushed Chair Powell to worry. The labour market might be weaker than it looks, and Waller isn't just any candidate. He's already on record advocating for exactly what the president wants. Interestingly enough, some experts have already coined a term for this, the Waller put. The idea is that Waller has a very low tolerance for a weak job market. He has a track record. In July of last year, he famously dissented from the Fed's decision, arguing for a rate cut. This suggests a Waller-led Fed would likely cut rates aggressively at the first sign of weakness, creating a kind of safety net or put for financial markets. Just before his meeting, Waller stated he believed rates could decline by a massive 50 to 100 basis points, citing concerns over a weak job market. That's the freshest signal yet of where he'd steer policy. This isn't happening in a vacuum. This is a high-stakes search for the most powerful role in finance. With other contenders, like BlackRock's Rick Rieder, still in the running, the choice of a candidate like Rieder is significant because it would represent a move away from traditional academic economists toward a market practitioner. A Fed led by someone from the financial industry might be more focused on real-time market stability and less on traditional economic models, making its actions harder to predict. The central conflict is now out in the open. President Trump has made his criteria clear, previously stating that while the Fed chair doesn't have to do exactly what we say, his is a smart voice and should be listened to. This selection process turns the test of the Fed's independence into a public spectacle, and that independence is absolutely critical. After all, research from institutions like the International Monetary Fund shows that when a central bank's independence is weakened by political pressure, it can lead to economic instability. If markets believe the Fed will cut rates for political reasons, long-term inflation expectations can become de-anchored. This means investors will demand higher interest on long-term government bonds, raising borrowing costs for the entire economy. The immediate consequence of such a dovish Fed, would almost certainly be a weaker US dollar. That has global ripple effects, including for China. For a Chinese-speaking audience, this is a critical point. A weaker dollar makes Chinese goods more expensive for American consumers, which could hurt China's export industries and pressure its own central bank to respond. This risks escalating into a beggar thy neighbor policy, where one country exports its economic problems In the near term, such a dovish Fed would likely be a tailwind for the stock market and could cause a rally in bonds. The key indicator to watch will continue to be the monthly jobs report. Any further signs of weakness will only increase the pressure for the rate cuts the president is demanding. And as we've been tracking, keep an eye on those sticky services inflation prints and whether that internal three-way split at the Fed persists. Speaking of immense pressure, let's shift from the Fed's struggle to steer the national economy to a single company under a different but equally intense kind of strain. We're talking about Intel's high-stakes, multi-billion-dollar bet to reclaim its former glory. Intel just launched its most advanced chip ever, the 18A, designed to reclaim its crown in the semiconductor world. But there's one giant problem. Its only major customer is itself. This comes after the company that once defined Silicon Valley saw its worst year ever, losing 60% of its value as it fell behind its rival, TSMC. What really brought this to a head was the intense competition and technological challenge. Here's where it gets interesting. In semiconductor manufacturing, the yield rate is everything. It's the percentage of usable chips from a single silicon wafer. For a process to be commercially viable, you need a yield of 70 to 80%. As of mid-2025, reports indicated that Intel's 18A yield was only around 10%, while TSMC's competing process had already reached 60%. If Intel can't efficiently produce its own chips, how can it convince others? Now, after years of delays, new leadership is drawing a hard line. The new CEO's internal message is blunt: no more blank checks. That was backed by swift action, with 15% of the workforce cut. The situation presents a fascinating duality. On one side, this no more blank checks policy signals a move towards fiscal discipline, which sounds good. On the other, it's a huge gamble that could mean they are prematurely retreating from the technology race, making it even harder to close the gap with TSMC. The entire comeback strategy hinges on a massive new chip factory in Arizona. However, if you zoom out, you'll see another layer to this, what the industry calls the frenemy problem. Intel designs its own chips that compete directly with companies like Nvidia and AMD. So, asking them to hand over their most secret designs to a rival's factory is a tough sell. While Intel has secured some customers like Microsoft and Amazon, a company executive admitted that the volume of chips these external customers have committed to is not significant. So with the private market hesitant, an unexpected player stepped in, the US government. So why the massive public and private lifeline? Let's focus on a single statistic that might just change your entire perspective on this situation. 92%. That's the percentage of the world's most advanced chips currently made in Taiwan. But that's not the whole picture. The US government's investment through the CHIPS Act has a very clear goal to reduce this dangerous dependency. The ultimate report card for the CHIPS Act will be whether it can increase the US share of global advanced semiconductor manufacturing from just 12% today to a projected 22% by 2030. As one former Intel board member stated, the idea that the world's supply is dependent on a single island just miles off the Chinese coast is a terrible situation for the whole world. This isn't just about one company's turnaround anymore. So, where does Intel go from here? The key indicator will be the production yield and performance of its own Panther Lake chips. If they can get that right, it could convince others to sign on. Believe it or not, Intel might just have an ace up its sleeve: advanced packaging. This technology, with names like Foveros, is about stacking multiple smaller chips together into one powerful package, which is critical for power-hungry AI data centers. Success here could become a high-value business all on its own, giving Intel another path to victory even if the foundry race remains tough. This is a crucial area to watch.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.